Welcome to Mad Money. Welcome to Cramerica. My friends, I'm just trying to make a little money. My job is not just to teach, to educate, to make it all make some sense. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. When in doubt, ask if there's a shortage or a glut of what the company in question sells. If it's the former, then you can buy. And if it's the latter, you better get out of Dodge. That's the best cheat sheet I can offer you at this point in earnings season. Shortages are the true north. Gluts are the kiss of death. And you know what? The average themselves, they don't tell you that. Dow inching up 12 points, S&P declining 0.01%, NASDAQ advancing 0.17%. They don't tell you anything. Now, I know that on a day like today, where the Fed meets, even if it's decided nothing, you can usually count on Fed Chief Jay Powell to control the action. But this result was not particularly surprising. And Powell didn't give us a lot to go on beyond assuring us that the economy's on firm footing. It didn't matter. When I look at the scoreboard for this period, who has the wins and who has the losses, though, it's all about the shortages versus gluts, especially for tech. So listen to me first about gold. It was a huge, huge win again today. We just don't have enough of it. You'd think that with all the miners out there, the supply of gold would grow 2, 3, or 4% a year, right? Nope. The miners only grow the supply by 1%. They don't call it precious for nothing. Plus, most of the gold is in places that are, let's just say, not so great for doing business. I like Agnico Eagle. They were on the other night, second largest gold miner, because almost all of their gold is in Canada, a normal developed country. Now the gold is broken out above $5,400 an ounce. And I'm telling you, it is not done yet. Many of the other gold havens in Africa and Asia seem attractive, but it doesn't take much for those governments to break contracts or just seize the assets directly. A mine in Mali was recently taken over by the government. 5 managers were detained. The standoff ended up with Barrick Mining paying a huge fine that severely dented their earnings. It was a bit of a shakedown. Both Agnico Eagle and Barrick were up huge today. I would keep the gold. I'm a gold bug from way back. Buy. Silver, on the other hand, could be experiencing an artificial shortage, as our commodities expert Carly Garner told us last night. She said this action looks like a corner, a manipulation. Even as silver's a plentiful metal, something that could collapse if the alleged corner blows up. Sell. We've got a big shortage in tech, one that it's really unlike anything I've ever seen. It's about storage and memory, specifically data storage. We just don't have enough of it for the data centers that are being put up all over this country and the world. We've heard this theme now from Micron and from Seagate last night. The former is a maker of sophisticated memory chips, and the latter is known for more reasonably priced commodity disk drives. These stocks are just, you can't even, boom! Micron's doing everything it can to alleviate the shortage. Sanjay Mehrotra, the effervescent CEO, seems to be breaking ground everywhere. It must be carrying shovels to put up new foundries. But you can't put these up overnight. They take years. They're just way too complicated. In this situation where you have NVIDIA's new high-end chips spewing data, Micron has absurd pricing power. So does Seagate, which last night made it clear that it's going to be very disciplined, isn't planning to flood the market with more disk drives, something that therefore assures a powerful roadmap to higher earnings, which is why that stock shot up 19% today. It takes about 4 years to build a plant that can make memory devices, so I think the shortage lasts for some time. Meanwhile, the stock of Texas Instruments, which had been stuck in the mud for ages, burst out of the bog, roaring nearly 10%. Management talking about tight supply for its industrial chips and chips for its new data center division. Tomorrow, we hear from the 2 remaining storage companies, Western Digital and SanDisk. Have you seen those? If Seagate and Micron are any example, I expect these stocks to continue ramping, even though they're already up 61 and 122% for the year. Yes, since the year began. And by the way, they were among the best 10 performers in the S&P 500 last year. When I was on the trading desk in my old firm, I'd periodically see a stock like SanDisk trading furiously each day, and people would say, hey, how could SanDisk, Jim, go from 237 at the beginning of the year to 527 now? And I would say, you know why? Because it has to get to 800, and to do that, it's got to go over 527. Do you know that that glib answer was invariably right? We're a nation short on power, too. For years, our electricity use barely grew. So power generation became a tough business. Bad business. Biggest company, General Electric, suffered mightily, surviving on service and maintenance revenues. Now, though, big tech companies are erecting data centers willy-nilly to meet demand again for compute and storage and cooling, and that's changed the almost moribund gas turbine business. It's now one of the biggest growth stories in the world. So GE Vernova, the GE Power spinoff, can't come nearly satisfying their clients. There's so much business there that they have the visibility on the earnings to the 2030s. You know, only J&J has that, and that's a pharmaceutical company. That's why that stock just soared today. Oh, my God, it never stops. Samsung with a great number. Now, tonight we heard from three members of the Magnificent Seven. They were wildly different results. They're not shortage. They're just idiosyncratic, as we say. Microsoft reported a seemingly better than expected quarter. Nice top and bottom line beat. But its stock sold off hard in after hours trading. Look, I've been telling you to watch that Azure, their cloud infrastructure business, capital expenditures. Wall Street's gotten worried about all the investment in artificial intelligence. On Azure and other services, Microsoft did okay, 38% growth on constant currency basis. Not enough to satisfy Wall Street. More importantly, though, Microsoft's capital expenditure budget, too high. Higher than expected, up 66% year over year. That's not what the market wants. Next. Meta Platforms, on the other hand, oh boy, they got the memo. They're rallying furiously. Social media giant reported huge earnings beat, very solid revenue beat. Plus, even though they plan to spend $135 billion on their AI build-out this year, management's confident that they can still grow their operating income year over year. In other words, they can afford it. That's one reason this stock is getting a much-needed boost this evening. Tesla reported, too, as I told you on Monday. This is the Magnificent Seven stock where the numbers barely matter, especially this time because we already had Tesla's production and delivery results, both of which we know fell short of expectations. So when Tesla reported tonight and delivered a surprisingly strong set of numbers, top and bottom line beat for the fourth quarter, very impressive, $1.4 billion in free cash flow. That was good enough to send the stock higher in after-hours trading. Hey, by the way, robot and robo-taxi intros look ahead of expectations, real driver of the after-hours moves. We can't wait to see that stuff. Beyond the Mag 7, let me throw in IBM. They reported a magnificent number. Oh, my God, Mag 8, I don't know. Software revenues up 14, very strong full-year forecast, inexpensive stock, flying in after-hours trading. You know I think IBM is incredibly well run by Arvind Krishna and is an inexpensive stock even here. Oh, and I can't resist. Last time I told you about Lam Research, semiconductor capital equipment. That was right. It's ripping. So here's the bottom line. The best performers in the entire stock market, not tech, the entire stock market, are companies that you may never have heard of. They make things that are in short supply, and their stocks keep soaring. The rest of tech, mixed bag if you don't have a shortage. Meta and IBM looking good. Microsoft sinking. And Tesla, a beast all by itself, and a beast that wants to roar higher. Dean in Ohio. Dean.
Hey, Jim. Thanks for taking my call.
You betcha. What's up?
Been with the Investing Club from day one.
Thank you.
The data center build-up will be in the trillions. Hyperscalers are the principal. A location that has been quoted as creating the largest and most efficient data center in the world. It's owned by Texas Pacific Land that has everything in abundance. Does it make sense to open a small position in TPL and buy on the way up? Thank you.
Well, okay, my problem is in the end, it is going to trade. They do have a bulk data center business, but it's still going to trade on oil and gas. You know we liked it last year. Oil and gas not my favorite. I think you can do it on a spec, but you're going to be betting, by the way, that oil's going to go higher. That's what's going to move it. Now we're going to go all the way down to Florida. We're going to Don in Florida. Don.
Hey, booyah, Jim.
Booyah, Don.
Okay, listen, I'm looking at Netflix. I mean, it's been down ever since the split, and I was wondering what your thoughts are long-term.
I think that you got to pull the trigger on Netflix. I'll tell you why. I actually like the Warner Bros. Discovery deal. I think that Zaslav put together the best movie studio in the world, best TV studio in the world. Netflix wants to have it. Am I going to tell Ted Sarandos that he doesn't know what he's doing? That's been a sucker's play. A lot of guys have done it. I won't. Sean in North Carolina, that Philadelphia accent's so awful. Sean, it would be like Sean? Sean in North Carolina. Sean. Is that right?
Yeah.
Hey, Sean, what's up?
It's an honor, Cramer. Would
Right
you
back
double
at you.
down or fold DraftKings?
Okay, I like DraftKings, but I've decided, you know what, without Florida, without Texas, without California gambling, it's just going to be like, I don't know. It's in the wilderness. I don't know. I want it out of the wilderness. It's not an expensive stock, or maybe we need a lot of consolidation. That could do it. All right, listen up. I think this earnings season's coming down to shortages and gluts. Sometimes it's as simple as a company like Meta blowing away the numbers too, though. Oh man, tonight, oh my God, we have what they always say that jam-packed stuff, which I think is nonsense. It is kind of jam-packed, though. We got the ServiceNow software king, and the stock is down 15. I don't know. I'm checking in with the CEO to find out. And Levi's, okay, that's easier because it's like pants and other clothes. That we're going to sit down with the CEO after the tariffs and the consumer and the DTC. And then Teva stock has soared 55% in the past year. What's behind that? Why don't we check with the CEO fresh off the company's earnings? So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
For a long time now, the enterprise software cohort has just been a house of pain because Wall Street's terrified they're going to be steamrolled by generative AI platforms that are very good at writing code. But we really haven't seen all that much impact in the actual numbers for these companies. Instead, the enterprise stocks, they've been pummeled by multiple compression. The earnings themselves have been fine, though. Just take a look at ServiceNow. Here's a stock that peaked exactly 1 year ago. It's now down over 45% since then. But tonight, ServiceNow reported what I thought was a pretty darn good quarter. And even better, they announced a $5 billion buyback, including a $2 billion accelerated repurchase, starts right away. Clearly, management thinks the stock is cheap. But will the marketplace, which has become a very cruel taskmaster for software as a service enterprise software, agree? Who's right? Earlier, we got a chance to speak with Bill McDermott. Take a look. Mr. McDermott, welcome back to Mad Money.
Jim, it's great to be with you as always. How you doing?
I am doing well, thanks, and it looks like you are too. You beat on every key line. I want to start with these numbers that you turned in tonight because I've got to say they look very strong overall. I'd like to know how it's happening. What are you doing?
Jim, this is the fastest company in enterprise software to ever hit $1 billion, $5 billion, $10 billion, and now $15 billion plus organically. We have a once-in-a-generation platform. We closed the year exceeding Q4 expectations in full year, and we're operating at the rule of 55, meaning we're growing revenue more than 20% and free cash flow margin more than 35%. And we actually upped that to the rule of 57 company this year. And basically, we're in an agentic AI universe, and companies today want a platform where they can fundamentally reinvent their business model. That platform has to work with the language models, the hyperscalers, the data lakes, and all the systems of record to compose a masterpiece. And we put that together, and we're winning.
All right, so Bill, I hear you. I now have to address the stock. I'm a stock guy. You are an enterprise software guy. Stock down 100 points from its high. Highly unusual. People are telling me this is because that AI, so-called AI, is eating software, or the customers can build their own software now. I know I've been building software with Anthropic, and that's hurting your business.
Yeah, that is, again, not true.
Okay.
And I'm very excited to tell you that not only is that thesis not in line with reality, but the contrary opinion is actually where the market is. Today, we announced a partnership with Anthropic, and I think Dario at Anthropic said it best, so I'll just quote him. There's a meaningful difference between giving enterprises access to an AI model and building that model into workflows where real decisions are made. So we already have partnerships with OpenAI and Anthropic, and again, if you remember, Jim, the world was going to change when there were hyperscalers and software companies going to disappear, and now it's the language models. Actually, we're harmonious with the language models. It's synchronous with business process reinvention, and we're leading the way. What I do see is I see feature companies and perhaps some functional companies actually being eaten by AI because we're becoming the great consolidator, meaning that these features and function companies are actually being consolidated into ServiceNow as we connect all of the workflow and the data fabric of these great companies so they can improve their return on invested capital. AI doesn't pay off by infrastructure alone. You got to connect it to business applications where companies can get the value. That's what we're playing.
Okay, so if that's the case and you offer so much, is it possible that people might say there are fewer seats being used, that literally enterprises to operate with fewer employees? Amazon laid off 16,000 employees today, that you can't do as much business because there are fewer seats at the enterprises you sell into?
Great question, Jim. We're actually increasing the monthly active users at ServiceNow 25% year over year. And there's still 1.3 billion seats in our target market. So we barely scratched the surface. Having said that, we have a hybrid pricing model where it's based on seats and consumption. And so we'll meet the customer wherever they want us to. But right now, we're expanding across east to west, across all business functions with the platform. And customers are consuming the apps in every department. And we're also kicking in customers now purchasing additional Assist AI packs as they run through the tokens in their original licensing agreement. So you're seeing now new vectors of revenue kicking in, which is why, not only why we beat the consensus and overachieved all of our objectives last year, but it's why I actually raised the guidance way beyond analyst expectations this year. And I want to make a point to the shareholders, because you're absolutely right. We got lumped in with a cadre of companies that have been sort of functional or feature companies, and that has re-rated the multiple. That's the only thing that happened to ServiceNow. And the second thing that happened is we tucked in a few M&A moves, and I think they were saying, hey, are they buying growth like they've seen so many times before? We proved that we weren't buying growth. We knocked that out of the park. And just to make it very clear, we don't live in the neighborhood where others live. We are one of one in the enterprise. It's the only platform that can reinvent business processes on the fly using AI and all the tools that customers are deserving of. And just to show the shareholders some love, I approved a $5 billion share repurchase and an immediate deployment of $2 billion of that today. So as soon as we can, and the window opens in the next couple of days for us, we'll be in at $2 billion. I also bet my personal comp all on the stock. So I couldn't possibly be more confident of where ServiceNow's entry point is now, how I expect the multiple to re-rate based on results that are one of one. Let's go.
All right, I want to be sure people understand that's an accelerated share repurchase on the $2 billion, meaning it's just going to happen now. So people who really do not like ServiceNow, they can sell it right into you if they want to.
They could do whatever they want, but if I was them, I'd hold. And for the people that are on the sidelines waiting for the story, Jim, let me explain just a little bit on these M&A moves. I proved beyond a shadow of a doubt, we didn't buy growth, okay?
Absolutely.
Knock that one down. I just told you our seats are actually increasing, not decreasing. And our TAM went from 90 to 600 billion since 2019, since I've been CEO. And I just re-upped for 2030, just saying that I have enormous faith and conviction in this business. But I also did some important tuck-ins. And you say, Bill, you asked me the last time we talked, why did you do that? Because you're a builder. Well, what happened was we waited some time to get MoveWorks in as it went through the process. And now we have an agentic AI user experience, that open door where you can search, get your requests met from any data source, and have a great experience, and all the actions are taken on ServiceNow. And then we went into two very critical areas for the customer. One of them, which is super important, is security.
Okay.
Jim, cybercrime is forecast
to
cost the world $1 trillion a month. So if that was an economy, it would be third, only behind U.S. and China.
Okay.
Huge problem.
And
so what do customers need? They need visibility and prioritization. They have to reduce their exposure before incidents happen.
Okay.
Real-time agentless discovery and classification of every asset. IT, OT, medical devices, industrial controllers, the whole 9 yards. Armis does that.
Okay.
So that's added to our great security business that's already growing 100% year over year.
We are going to have to move on, but I think we made all the points. I really want to know what the Bears say now. You know what I mean? Let's see what they say now.
You know what I want to... What can they say? I mean, what they can say is, let's re-rate the multiple because they're living in their own neighborhood.
I get that. All right, look, I want to thank Bill McDermott, Chairman CEO of ServiceNow, and a great advocate for his shareholders. That's what you must understand, his shareholders. And Mad Money's back after the break. Thank you, Bill.
Jim.
Coming up, with Levi's on the move after reporting earnings today, Cramer sitting down with the CEO to find out whether the brand will be stretching its legs in 2026. Next.
After the close, we got the latest numbers from Levi Strauss, the iconic denim maker. They delivered a modest top and bottom line beat. However, the full-year earnings forecast was a little light, even as the revenue forecast was solid. We got to drill down on that. This is a company that's had a lot of success broadening out its selection of merchandise beyond just jeans. But Levi's has also suffered from President Trump's trade war. The last time they reported 3 months ago, the stock had soared going into the quarter, sold off hard. It's been struggling to find its footing ever since, as has almost every single apparel company. So what's it going to take to breathe some life into the stock? Let's check in with Michelle Goss, the president and CEO of Levi Strauss, to get a better read on the quarter and where her company's headed. Ms. Goss, welcome back to Mad Money.
Hey, Jim. Great to see you. Thanks for having me.
Well, I'm so glad that we have you on. I want to start out by saying that I'm looking at the direct-to-consumer, which is a nice acceleration. I want to know how that's happening, because it does seem to me that can be a very lucrative business for many, many years.
Absolutely. I mean, Jim, we're really pleased with the full year and with the quarter, and DTC has really been a bright spot for us. 15 quarters of positive comp growth. This quarter, DTC was up 10%. That was driven both by our stores and online e-com, up 22%, really capped off the year at 11%. But we have a long runway of growth for direct-to-consumer. It's now half of our business. And one of the things we've been working on hard here at Levi's is really rewiring the company to operate as a best-in-class retailer, to execute in our stores, drive merchandising, head-to-toe offerings, and it's happening, and you see it in the results.
Well, look, I know I've got other questions that are about the numbers, but I can't help but witness what's behind you. It is not what I expect. It all seems very different, very cool. What is going on? This is not, you do not have slacks behind you that are denim.
Yeah. So if you take a look, Jim, we're just days away from hosting the Super Bowl at Levi's Stadium. I mean, this is such a huge moment for the city of San Francisco and Santa Clara, for the Levi's brand. We're super proud to have the naming rights and be a partner with the stadium, with the Niners, over a decade and running. And like I said, very excited to host the world here just in a few days. And one really big moment for us is that we are going to have an ad on the Super Bowl the first time in 20 years. And that will be the kickoff of our next brand campaign. Now, so, yes, little celebration of product right behind us. It's a big moment for us.
All right. Now, Chip Bergh, your predecessor, when he named it, the stadium, I said, I don't know, it's going to work. It turned out to be, it's one of the namers that did work. It is one because I think it's a consumer brand. It gets featured. They have to mention it every time, every single time. So can you expect an actual lift because of the name?
I think it's everything together, Jim. It has been a really smart investment for us. It's been a great ROI. We get a lot of reach by having the name on the stadium. And we're really looking at this holistically. As I said, we're launching our brand campaign during the Super Bowl, and the city will really be lit up with Levi's activation. So all in, we expect to really kick off the year with momentum. And if you think about this last year, it was really, for us, center of culture around music. as we head into 2026 and, we're planning for growth again this coming year, it really is the year of music and sports. Super Bowl coming up, World Cup this summer, and stay tuned. It's going to be a lot of excitement.
Okay, Michelle, what's going on, do you think, between the stock market and apparel? Has everyone just said, look, until we resolve tariffs, we don't want to touch them? Because, it has been, as you and I both know, it's been a tough sell, whether you're good or bad. The guys who have shot it out, really just crushed it, their stocks are being trashed right now. I've got to try to figure this out. Maybe you can help me.
Yeah, I start first with, of course, it's all about the long term. Mm-hmm. And we are really pleased to continue to beat expectations on the top and the bottom line, and to be delivering the kind of growth that we know that we can. A mid-single-digit growth company. We did it this year, 7%. We look to 4 to 5% next year, 5 to 6% reported, and expanding margin at the same time. So over the long term, I believe that, the stock catches up, but it's our responsibility to continue to drive results. I also think an important part of our strategy right now is moving the brand from just standing for a pair of jeans to head-to-toe denim lifestyle. That strategy is working, and it's expanding our addressable market. And I don't know that the consumer has fully caught up on that yet. No. Our tops has been double-digit growth, again this quarter, but it's only 22% of our business, which says there's a huge runway ahead.
Now, there was a terrific piece by Raymond James. It was December 22nd. They talked about the international runway, especially Asia, being very large. I do think that of the companies I follow, you may, in the apparel area, you may have the best shot at really big growth in Asia.
Agree. It's an opportunity. We are still underpenetrated in Asia. Our international business overall is growing nicely, up 8% this quarter. But when you think about Asia, yes, in our more established markets, like take Japan, that market's been on fire for a while now. India is growing really well. But throughout Asia, we see a ton of runway for us. And
I do want people to understand exactly how much, because we talk all the time about it, but we don't get the percentages. Women versus men, and the opportunity with women, because where the whole mosaic, women are as a percentage of the whole.
Yeah, boy, is this an opportunity for Levi's. We've made great progress. Women's is now 38% of our business, and it was a much lower number not that long ago.
Congratulations, you've done that.
Yeah. The team is driving. It's really across the board. It's leaning into all of our strategies. Start with product. I talk about head-to-toe denim lifestyle, tops and bottoms, dresses, skirts. Women's was up 11% for the year, and we have a long way to go between 38% and 50%, and that's incremental business for us. And, we're executing like a retailer. You go into our stores today, we've made deliberate moves to connect with her. Mm-hmm. In the majority of our U.S. stores, as an example, women's is now merchandised at the front of the store. A lot of use of mannequins to showcase those looks, connecting through social media, marketing, the partnership with Beyonce. So, I can't tell all of our secrets for the years to come, but let me just say, I think we're going to make really good progress with our female customer again this year.
All right. Well, I look forward to watching the Super Bowl from Levi Stadium. And I want to thank Michelle Goss, President and CEO of Levi Strauss. Michelle, these numbers, one day people are going to realize how much money you're really making. It's just right now, people say apparel. I think it's going to run its course. Thank you for coming on the show and thinking long term.
Thanks, Jim. Thank you so much,
Absolutely.
Jim.
Mad Money's back after the break.
Coming up, after being lost in the wilderness, Teva Pharmaceuticals has been surging the past few years. So Cramer is talking to the company's CEO to learn what's behind the turnaround. Next.
All right, what the heck has gotten into the stock of Teva Pharmaceutical Industries, one of the world's largest generic drug makers, but I think it's far more than that. After spending a few years lost in the wilderness, the company brought in a new leader, Richard Francis, at the beginning of 2023, and the stock hasn't looked back since. Nearly 400% gain from its 2022 lows. You better listen up. 54% gain just over the past 12 months. This morning, Teva reported, although it had already pre-announced when I was out there at the JP Morgan Healthcare Conference, the quarterly results still came in higher, but management full-year forecast, some people said it was a little light. I don't know. Initially, the stock went down 9%. That was just crazy. Frankly, then the stock stabilized after the conference call, and then it finished up more than 2%. That's sane. So what happened here? Is there more room for the stock to grow? Let's dig deeper with Richard Francis, the president and CEO of Teva Pharmaceutical Industries, to find out. Mr. Francis, welcome to Mad Money.
Jim, thank you for having me. Really pleased to be here.
I'm just going to say, when I saw you at the JP Morgan conference, I was looking at Teva and I said, hold it, Teva is a Me Too outfit. You are attacking the hardest thing in the world. You are attacking the brain, and you have had excellent success with it.
We have. Well, yeah. Thank you for having me, Jim. And yes, and thank you for making us one of the picks in JP Morgan week. I have to say that felt like we've come a long way.
Yeah.
But yeah, neurology and CNS is a huge challenge, but it's a huge opportunity. There are many, many millions of patients who actually suffer from many diseases. And I think at Teva, we're very proud that we've taken on schizophrenia, we've taken on migraine, we've taken on tardive dyskinesia. So some of the hardest diseases, but that's where we have the biggest impact and make the biggest difference.
Well, let's talk about the tardive dyskinesia and Huntington's.
Yeah.
These are diseases that when you have them, especially if you're trying to get off antipsychotic, the word is, sorry, there's nothing.
No.
That's not the case.
Absolutely not. And look, when we started this pivot to growth strategy, we looked at Austedo, and analysts had peak sales of 1.4 billion. This year, we've just closed out at 2.26 billion, and we have peak sales of 3 billion. And the reason why that's changed is, one, there's a massive untreated patient population. 85% of patients are still not on treatment. So that feels tragic.
And you're trying to get awareness too, which I salute you for. We have a great campaign, Huntington's.
Oh, did you see that? Yeah, I know. And so we're trying to do that to make caregivers and people who suffer from it aware that they can go and see their physicians and they can say, is there a treatment now available? Start that conversation. And then Austedo has a dramatic effect when patients take it. It can really transform their quality of life. They go from being a hermit to getting back out in society.
A hermit is right. People don't go out.
They don't.
Now, you are one of I take the CGRP that is made by a competitor, they were first.
Okay.
But yours is a very popular migraine injectable, and these work. I want people these work for many, many people. How is yours selling?
Well, incredibly well. In 2025, it was up 30%, right? And now we've given a forecast next year that has tremendous growth in it. And I think this is another great story about Teva. So when we started this strategy, this product had sort of been left a bit to flounder.
Yes,
because
it was.
Competition was high. There was orals coming in.
Well, it's Lilly, it's Amgen. These are hitters.
They are hitters. And when I came in, we got the team together and said, no, there's a huge opportunity. We just got to focus on it. We've got to build up our muscle. And I think we can commercialize this better. And across all of our regions across the world, we've grown it year on year, grown market share. And I think this shows the grit that we have at Teva, the grit and the focus. And when we apply that to our assets, we can generate real return. And I think now we're saying Ajovy can do $1 billion. And that was a forgotten drug a few years ago.
Okay, so let's talk about the future. Those of us who tried hard to help when the antipsychotics and schizophrenia, I never give up. I'll never give up. But there are many people who have. What makes you feel so good about what you have?
Well, I think I'm glad you sort of feel very passionate about it. We do. I mean, there are 4.7 million people in Europe and the US who suffer from schizophrenia. It is a really debilitating condition. And what we have with our pipeline, we have Uzedy, which we launched as a long-acting risperidone, which, by the way, everybody said it's a congested market. You're not going to do anything. That was up 63% last year. But
well, there was doubt. I mean, look, there's doubt because we know everything keeps failing.
But what you need in schizophrenia is you need to have compliance. And compliance comes if you have a 1 or 2 month injectable, because then you don't miss your dose, and that's really important. And as we look forward to the launch of olanzapine towards the end of this year, olanzapine doesn't have a long-actable. It's the most used molecule in schizophrenia because it's the most efficacious. So it's reserved for the most severe patients with the most severe conditions. But what you need there is you need compliance. So when we launch LAI, our long-acting olanzapine, I think we have a real opportunity to transform the treatment for those patients. And there's already a lot of excitement about it. But then I think we have a schizophrenia franchise, which is second to none, which is really exciting for us, for the patients and the physicians.
So what happened to Teva? I know you as a knockoff company. What did you decide to do? Why did you think it could be more than that?
So, well, we're very proud of our generics business. That gives huge access to medicines, and so I'm very proud of that. What I saw was we had this innovative capability. It's like a muscle. It atrophied over time. But when I came in, we put the strategy together. We said, we have capability. We have assets. They're not being focused on. They're not being invested in. Let's go after it, and let's go after it aggressively. And so what we've done in a very short space of time is transform the revenue expectations of Austedo, Uzedy, and Ajovy. But also, we moved our pipeline through the clinic so much faster than people thought. And because of that, we're going to have an opportunity to launch four products in 5 years.
And this year itself, 2026, should be a big breakout year. That's why people are buying the stock.
I'm glad you mentioned that, Jim. Yeah, absolutely. We have 7 milestones this year, and they're all innovative. We have the data coming out on duvakitug. We have the data on vitiligo and IL-15, the data on celiac disease and IL-15, the data on emrusolmin with the MSA, the data on olanzapine when olanzapine launches, the aspa product coming out, and finally the PD-1, IL-2 in oncology. That doesn't sound like a knockoff company. That sounds like a world-leading biopharma company.
You have embraced science in a way that I think a lot of other companies should, because they're afraid to fail. That's why they go after what I call the easier illnesses. But you don't seem to be afraid to fail.
Well, we're not. I think we play to win, and we'll deal with failure when it happens. But we don't let that intimidate us not to do things. And the quality of science we have at Teva, I think, has been way underestimated. And now we're starting to show that actually our products, and as our data gets revealed this year, I think we'll show the quality of what we have. And I think that gives us the confidence to keep going, keep investing, and transforming this company.
You're absolutely right. I remember when I was first on the migraine drug, and someone said Teva, and I said, why would I want to use the knockoff drug company? And it said, well, have you looked? Have you looked at what they're doing? You're changing things dramatically. I want to thank Richard Francis, President and CEO of Teva. You got to look at this company. It's not what you remember it as. That's what matters. Mad Money's back in for the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
Our calls today were the same. I said about myself, so just because I know this close stock at a time, my temperance and graphics on my you play this out. And then the lightning round is over. Are you ready? Ski data. Time for right one. Mike in Illinois. Mike.
Jim, how are you?
I'm doing well. How about you, Mike?
I'm doing great, thank you. First off, I really enjoyed your new book, especially the way you talk about. You're welcome. Especially the way you talk about understanding business, the way your mom understood ShopRite.
That's what it's about. It's about my mom and my dad and the mistakes they made. Thank you. So others don't.
Yes.
Let's go to work.
I've been thinking about Robinhood the same way, not just as a stock, but as a product people actually use and stick with.
And you're right. Robinhood has captured that young cohort. He's captured the minds, imagination of young people, as I try to do, and I can tell you they are on Robinhood, and it is a buy. And now I'm going to Edwin in California. Edwin.
Hey, Cramer, big booyah to you. Wanted to get your thoughts on Satellogic Inc., ticker symbol SATL.
Yeah, this thing is a parabolic move. When I see a parabolic move for a company that's about to have a big earnings step up, I say I got to call Ben Stoto, because I am not going to say that this $5 stock shouldn't be for you. And this is the only book that ever recommends speculating. Maybe it's the one we should be speculating on. So let's do homework for you so you're better and can make more money. That's kind of the goal of the show. Unless you want to talk policy, and then you should turn me off. Let's go to Bill in Texas. Bill.
Booyah, Jim. Thank you very much for taking my call. I'm a proud club member, a longtime listener, and I certainly value your opinion. But what I wanted to ask you today, what's your current thoughts on energy transfer?
I think that I love those ads on the NFL. I think the stock's up big since then. By the way, so Zoom, it's the NFL ads. Let me tell you something. The yield 7.3, very inexpensive stock. Great pipeline company. Kelsey Warren. Okay, so I was mad at him for like the first 5 years of the show, but hey, bygones be bygones. Buy ET. Let's go. Don't. I'm hot here. Let's go to John in California. John.
Jim, I'm a club member, read your book, and I'm an investor, not a trader. Software companies have fallen due to fears about AI eroding their competitive advantage. How do you feel about buying into it when the MACD line crosses the signal line?
Maybe it's going to be technical, but I've got to tell you, I feel like I am so beaten down. No, this is enterprise software. It's not software as a service. So I think it should do better. So I agree with you. I would be a buyer. But, oh, my God, these stocks are so heavy. I feel they're like wearing cement galoshes. Okay, let's go to Lori in Florida. Lori. And I'll pronounce it any way I want. Lori.
Booyah, Jim.
Booyah.
Lithium Americas.
No, we're not lithium people. We're not, well, in some ways. But no, we're not going to. I know. Hey, I play with an open hand, but this kind of lithium, no. We're going to say it's too speculative for me. And that, ladies and gentlemen, lightning round.
The Lightning Round is sponsored by Charles Schwab. Coming up, Starbucks appears to have finally righted the ship. So should you hop on board? Cramer's cracking the case. Next.
When Brian Niccol took over as CEO of the down-and-out Starbucks in August of 2024, he had one goal, getting you a cup of coffee in 4 minutes or less. Today, we saw the fruits of his labor, a gigantic upside surprise to same-store sales, how the average store did versus last year. And for a moment, it looked like Wall Street was finally seeing the darn light at the end of the tunnel, although the stock eventually pulled back hard over the course of the day. That's what happens when you run big into the quarter, which was the case here. I still think it was a huge positive. When Brian Niccol took over, he spent months trying to figure out what was wrong with Starbucks so he could take it head on and create a long-lasting turnaround. To do that, he relied on his experience turning around Chipotle after he took over in 2018. One of the greatest comeback stories I've ever seen. At the same time, he told me that he had to reduce the time it took for Chipotle to get you your food. He tinkered, he changed things up, and he solved the knotty throughput problems that permanently changed that company's fortunes. He's now managing to do the same thing at Starbucks. The throughput for both mobile and in-person orders was just way too slow. People were just saying, I can't even wait. By changing up customer service standards, having bigger employee rosters, lower partner turnover, and delivering what he called consistent, timely, and personal service, no pizzazz, just basic blocking and tackling, he has changed the guts of the experience. This throughput improvement brought new customers. The active members reached 35.5 million customers. Rewards transactions grew for the first time in 8 quarters, and even non-reward transactions grew, highly unusual. In fact, this was the first time Starbucks grew both rewards and non-rewards transactions since the second quarter of fiscal 2022. More transactions. That's what you want, not on price. And that's how Brian's been able to win the morning, or I should say, win back the morning, because Starbucks can finally handle its early traffic. What's winning the morning look like? In Brian's words, quote, people come back to the brand and we also drove engagement or more frequency with our existing customers. That's a really strong foundation, end quote. Once Niccol had solved the basic throughput issue, he was able to close stores that couldn't measure up, put more resources into the good ones. He's now able to target the afternoon day part, which could be huge, given how much people love cold brew. And he's installing digital menu boards to allow them to, quote, day part the menu. New verb. Now that he's got the blocking and tackling down, Niccol's introducing new flavors, like protein drinks that look to be a home run. Have you tried that vanilla protein cold brew? Wowza. But Brian isn't overloading the baristas with new drinks. In fact, he cut back 25 to 30% of the menu and offered measures in introductions, mostly with a health and wellness focus. I like that. You're not going to turn Starbucks around by layering on even more difficult to make drinks, which slows down everything. Tomorrow, Niccol will expand on the turn at his Investor Day meeting. I think you'll hear more about what's returning Starbucks to the rightful place in the morning. Of course, it's not necessarily a needle mover, as this stock had run up into the quarter, as I mentioned, but it makes for a much more compelling long-term story. We have a huge position in Starbucks for the Charitable Trust. We aren't going to buy more, I can tell you that. But if you don't own any, I think this turn is solid and long-lasting, and the price is going to be right. I like to say there's always a bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC or its parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and/or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.